good morning and afternoon, depending on which time zone you're in. So my name's Laura Robichaux. I am the director over the state and local tax group. And I also have David with me. He is a state and local tax manager. And what we're going to talk about today is probably, been on a lot of everyone's mind of, dealerships and how they're impacted by all the new Wayfair standards. I can tell you that our past year or two has been pretty busy in terms of, clients coming forward and asking, how do all these new state changes impact my industry? Here, let me go back to this. This is so our contact information is on here. If there's any questions after the presentation, you can always feel free to reach out to myself or David, and we'll be more than happy to help you work through any problems. What you'll find is, as we're almost, I think, past a year of post Wayfair changes, that these changes have kind of made most businesses think about how they need to change, not well, I shouldn't say change, how they need to approach doing business maybe differently for sales tax compliance. David's going to go through different types of examples, real life examples, to kind of do some modeling in terms of how this might impact different types of entities that operate in the dealership world. We're also going to talk a little bit about, towards the end of the presentation, how income tax impacts this as well. So a lot of companies don't realize that when there's a sales tax change, there's probably going to be a domino effect, and it's going to impact your corporate taxes as well. So we're going to touch base on that. And so I'll hand it over to David to talk a little bit more in depth about the Wayfair decision and how that's impacting dealerships.
All right. This is one of my favorite signs. I thought I would share it with you. And the best part of this sign is I encountered it in Sweetwater County, Wyoming. I love their bottom line, their bottom tagline on this banner, that they are asking you to vote for the tax that you do not pay, but it benefits us all, because they are imposing a tax on lodging and tourist type services. But there's a bunch of old history that goes back with taxing on sales that were running between states. I'm going to spend about 30 seconds on it. Many years ago, it was decided that before a state could make me collect tax, I had to have some substantial physical presence in the state. And that was the way it went for many years. Then come the summer of 2018, our Supreme Court decides that, hey, when a state decides to make people who sell more than $100,000 into a state or 200 transactions, when the state does that, it is not creating a burden on interstate commerce. And that opened the floodgates of states passing all sorts of new laws. The people that are imposing these new laws on are what they call a remote seller. You may think, I am a dealership. I am not a remote seller. A remote seller could be defined as anyone who sells tangible personal property by any method, including phone, chat boxes, online order forms, catalogs, or even a fax machine. That still qualifies as a remote sale. If you took that order by fax and shipped the product to North Carolina, you are a remote seller. Here's a pretty innocent looking business, one of the better barbecue joints in Texas. And it looks like they serve barbecue every Saturday morning, and that's it. How could they be a remote seller? Because they just serve barbecue. Well, actually, they have a website, and I can order all kinds of wonderful things from them right off their website. Almost everybody can be a remote seller just by taking an order or over the phone. So our first quiz question is my pitmaster a pitmaster or a remote seller? They offer online and phone sales that buy their t-shirts, or they'll even overnight you barbecue or barbecue sauce or coffee cups. I guess we'll start our polling question. True or false? Are they a remote seller? They are a remote seller. Wonderful.
So, David, I have a question.
Yes.
Have you ever heard of the company Carvana?
Yes, I have.
Okay.
They have the car vending machines.
Yes, they do have the car vending machines. So they have in Phoenix, they have like a big glass box, and that's the car vending machine. But you can also go on their website and purchase a car. So I actually did that, and we bought a Tesla, and it came from Texas, which is where the inventory was housed, and then it got shipped to Phoenix, where I live. So would you consider that a remote sale?
Yes.
Yes.
Now, there may be some differences around motor vehicle excise taxes and such, but yes,
Okay.
the basic transaction is a remote sale.
Okay. Would the car being stored in Texas by Carvana, would that create Nexus in Texas? I realize that rhymes, but yes.
Would storing this inventory of used vehicles in Texas create a need for Carvana to collect Texas taxes?
Yes.
That is correct. They would, because
Okay.
storing inventory is one of our #1 Nexus creators.
Okay. Good. Thank you.
The question we get a couple times today for the past year or so has been, do I have to register in every state? Well, good news is we do have 50 states and a couple territories. Only 45 of our states have a sales tax. There's 5 right there that we don't need to worry about. What we are most concerned about, though, is how these states have drawn up their rules that say, if you do these things, you need to collect our sales tax. And they fall into a couple of categories. The or states. They are the states that say, if you sell over a dollar amount into our state or over a certain quantity of invoices. And usually it's been about $100,000 in sales or 200 sales into the state. A heavy equipment dealer, $100,000 is one use piece of equipment. Or you could be an online retailer of sparklers or watch bands and sell 200 transactions and not have many dollars. We have some states that use the gross sale number. And so it's gross and 100,000 in sales and 200 transactions. That would allow our equipment dealer to make his 1 or 2 sales or 199 sales into the state without having to collect tax because he did not meet both. Oh, sorry. We have our choice states. They're going down in number right now, but these were states that gave you a choice of register and collect our sales tax or jump through all these hoops and report to us on your sales to your consumers. And just for reference, those reporting requirements are difficult, almost impossible to meet, and they do that on purpose. And over in the unique, we have a couple of states with some just different take on things. But we're not, a majority of these are an or state. And don't worry about writing these down or copying the slides. I'll show you a link where you can find this stuff later in the show. But Arkansas, Georgia, Hawaii, Maine, Maryland, all at 100,000 to 200 transactions. There's some more states, New York down through Wyoming. So our majority are these ORs, typically at the 100,000 range. There's a few that are higher, but if I needed to keep a number in my head, it would be $100,000. We've got states that are gross sales only. That is, we don't care how many items you sell here, you just have to trip in Alabama, $250,000. Oklahoma's 10, but Ohio is 500,000 and Texas is 500,000. But if you keep that $100,000 number in your mind, it's a good starting point. So far we got states that say dollars or quantity of sales, and we have some states that just say dollars. We have 2 states where you have to trip the dollar line and the quantity line. So in theory, in Connecticut, I could have $10 million in sales for 5 transactions. I did not meet both. I would assume that will change sometime in the future. Seems like they're shorting themselves. Minnesota is the one unique state. They're at $100,000 from at least 10 invoices or just 100 transactions. I would keep the $100,000 number in mind. So we get, question quite a bit. Am I a remote seller? I only sell over the phone, or I only sell this way or that way, or I only sell by mail. This summer, there's a little experiment that we conducted to see if the Tadich Grill, which has been operational in San Francisco since 1849, what was the lowest tech way we could get them to qualify as a remote seller. We went to some pretty extreme lengths here. I mailed them a letter. We put it up on the typewriter, signed it by hand, very low tech, manual typewriter. I sent the letter cross country in June by horseback through the Pony Express reenactors. So an actual letter carried across the nation on horseback to San Francisco because I wanted a coffee mug. So the question then became, if our restaurant first opened in 1849 at the very end of the Pony Express route, since they're accepting orders delivered on horseback for shipment out of state, does this make them a remote seller? True or false? Accepting an order that was delivered to my door on horseback and mailing it out by postal service, am I a remote seller? Yes, you are. You sold a product by almost any means or the lowest tech means, and you shipped it to another state. You sold remotely into that state. So we'll go through just a few of the different layouts in a little more detail now that we've shown that pretty much anybody can be a remote seller. We have some choice states out there that you collect or report. We have these states and they have laws saying either report your sales to us, and that comes with a whole bunch of hoops like mailing letters, notices on your invoices, notices and check boxes on your websites, variations of this, and usually sending in some summary list to the state by a specific date saying who you sold to. And then that point, if they audit you, there will be fines associated with, did you not put somebody's name on there? Did you not put the right dollar amount on? And they try to use that as a revenue source. These states have made the reporting option so painful and so hard to do that your next choice is to collect the sales tax for them. And that is what most people have chosen to do. That is, if I have a choice, I will say you really should look into collecting the tax versus trying to do the reporting. Collecting the tax is easier and has a higher probability of success. But just a little bit of detail, Washington was one of our states. They were one of the first states to do it. And it's just the highlighted parts in these next few slides that are really important. They've thrown out on their website that choice one, collect and pay tax. Great. So we have our retail sales tax threshold. It was $10,000 met in 2017. You begin collecting, you either met the threshold in 2017 and you started collecting in the beginning of 2018, or if you cross the threshold at some point in the year, you need to start collecting 30 days after you cross the threshold. Also in Washington, that's why we picked this one, if your sales are high enough, they impose what they call a business and occupation tax. It is effectively a gross receipts tax on your revenues. And it runs about 0.5%, I believe. Now here comes the other option, notice and reporting. You must provide a notice on your platform, a notice printed on your receipt, which can be difficult because most systems limit the length of those. And you'll report purchases to the purchaser. So you need to send your shoppers, even if they only bought one thing, send them a letter at the end of the year and mail it in the Department of Revenue. This platform notice has specific language. It's very specific. They make it super hard to comply with. If you can, avoid the reporting. Go for collecting tax. Oh, well, will Amazon charge tax for me? Yes, they will. There are many states that have passed what they call a marketplace facilitator law. What they're doing is saying that Amazon, Etsy, eBay, and other similar locations are like a choke point, and it's easier for the states to make Amazon and these marketplace facilitators collect the tax than it is to make all the little people selling collect the tax. So I believe there's 20 some states now where Amazon will charge tax. If I sold something on Amazon or eBay, it's shipped into that state, that sales tax appears on the buyer's invoice. The seller never sees the sales tax. The sales tax is remitted to the state. That does take a lot of pressure off. Problem with that is it's not all the states doing it. You still need to watch the registration, and it only covers those sales that you're selling through the marketplace providers. So while it is common for car dealers to move old, like non-stock 24 inventory on eBay, that takes care of those remote sales in the states that eBay collects for. It doesn't take care of the states where eBay doesn't collect, and it doesn't take care of the transactions through your normal remote methods. This is a list of the states where Amazon is being pushed into collecting tax. I pulled this off the Amazon website about a week ago. So you can see there's quite a few here where the marketplace providers are being pushed into collecting tax. So yes, Amazon, eBay has started collecting for you. Well, that's 45 states that have a tax, 23 that are doing the marketplace provider, and it's still 22 states that you need to watch out for. Anything that's going through your phone, your catalog, your fax, could even be a Pony Express order that comes in one day. But you still have to watch those sales. Now, this is where I'm going to hand this off to Laura at this point. So we're looking at what we're seeing coming back, 52 weeks later from this Wayfair is, are the states hunting remote sellers? Are these remote sellers lined up in a nice little row for hunting? Yes, they are. And these are.
Is that a turkey?
That is a turkey.
Okay.
That is a whole
Wow.
family of turkeys.
You can tell I am not outdoorsy. Okay, thanks, David. So a couple of things that I wanted to touch on, and I hope I don't make everybody dizzy, but I want to go back a little bit till we look at some of these. Where's that chart with all the dates on it? I just kind of want to make sure that this is really clear. Sorry, bear with me here.
Yeah.
Okay, so let's look at this really fast. So as a dealership, obviously the main line of revenue is going to be selling vehicles. But what we've seen industry-wide and some disruption within the industry from an economic side is that more dealerships are kind of branching out to, they do special, my husband got his truck lifted. They do special modifications. They sell parts remotely. In some instances, maybe they're warehousing inventory in different areas. All of that, kind of combined together makes a difference. So David did a really great job of laying out, these are all the different state rules. What I wanted to touch on is, let's just use, let me see, what's a good one here? Colorado. No, let's use our fun friend, California. So California, under all these new sales tax economic nexus rules, California came out and said, you know what, starting April 1st, April Fool's Day, I thought that was interesting. April 1st, 2019, our economic nexus threshold is $500,000. Now, what does that mean to you? It means that if you're a CFO, if you're a controller, maybe you're part of a sales team, here's what I would suggest. You first want to figure out, do I meet this new economic nexus standard for California? You would take your sales record, like let's say we're back in April, you look at April 1, 2019, run a report from April 1, 18 to April 1/19. And if your sales for ship to, because that's what really matters here, not necessarily bill to, is all the sourcing now has changed. And this is kind of leads into how this impacts your corporate tax. Your sourcing is going to be, okay, where did my inventory go? What's the ship to address? And of my ship to addresses, did I hit $500,000? So if you answer yes to that question, oh yeah, we did. We did like 1 million in California, or no, we're getting close. What this means is, if you look at this chart, that means that if you did a $500,000 between that 12-month look back period, California says that you have Nexus from April Fool's Day forward, not necessarily April Fool's Day backwards 12 months. So that, I guess that's why the date here, the effective date, is really, really important, because maybe you triggered that Nexus. However, it's not effective until the date that it becomes effective. Now, if you had that same situation, but you popped yourself into Colorado and you already hit that threshold, that means that you have some potential liability from December 1 go on a go forward basis. Now, a lot of questions I get is, Laura, well, maybe we did 500,000, or maybe you're a company that operates in the dealership world, and maybe you did like 1 or 2 big contracts, and that's really it. So for sales tax, it's really important to remember that once you turn it on, it's hard to turn it off. It's kind of like, especially in California, once you enter into that relationship, it's really hard to break up with them, because they want, you have to prove that you're not doing business there anymore. So David and I get a lot of questions from a consultative side, hey, we're going to flip on the switch in Colorado or California, when do we turn it off? Well, you don't really turn it off until you know that you're not going to establish a market there anymore. Once you've said, okay, we're never going to do business in California again, which some of them are like that, that's when you can shut off Nexus. But it's not as easy as, okay, 1 year we're in, 1 year we're out, and then the next year we're in and we'll see what happens. It doesn't work that way. If you want to operate that way from your business standpoint, you're just asking for the state to come in and be really aggressive. So I, many years ago, worked for the Arizona Department of Revenue, and I've also worked for the Idaho Tax Commission, and I am a trained auditor. I can tell you that there are states out there that are really aggressively pursuing these new laws. So David kind of walked through the brief history of Wayfair and how that impacted us. I can tell you we're 12 months into this new changes, and almost 95% of the states have already changed the rules. Like they all hopped on that wagon fast. So here's what we know, and here's what you may need to be aware of is, David went through the rules. I'm going to kind of go through how the states are reacting. California, and some of you may already know this, if you sold anything online, California has been going back and reviewing any records specifically from Amazon, and then also some of their other sources, to determine who's selling stuff into our state. And then what they've decided to do is, okay, we know that you sold something into California. Here's a letter, which I wish we should have put a copy of that letter in here. A letter of, hey, we noticed that you've been selling into our state. You are now required to file a sales tax return. Maybe some of you have already received that type of letter. Texas is also cross-referencing any of their franchise tax returns against their sales tax permits. California does the same thing, except they do it twice a year. So Texas and California are probably 2 of the most aggressive. Washington, I think we should add on here too, because they also are pretty hungry for audits. And Massachusetts, they tend to be, they want to be the front runner in everything. So Massachusetts also has jumped on the Amazon. And I don't want to just say that Amazon tends to be the big guy in the market, but there are so many other online platforms that dealerships sell stuff through, or even provide services through. So it's not just Amazon, it's so many other places that they can catch. New York has had, I think back in 17 or 18, has had the economic standard out there. They're just going after going after remote sellers more frequently. North Dakota has decided that they're going to start cross-referencing any withholding with sales tax permits. And let me explain why this is important. A lot of dealerships, especially if you do fleet sales, are going to have like remote employees that perhaps maybe are salesmen or, office support, something like that. So if you have an employee in North Dakota or any other state that you withhold payroll withholding on, and remit it to the state, North Dakota and Washington, I think several others, are cross-referencing who that payroll withholding is coming from against, okay, who has a permit. So I would really encourage anyone that if you are remitting payroll in a state, or you have a person there, regardless of what they do, they could be sales, they could be office support, they could be whatever, you're probably going to have to file a sales tax return in that state. That's just the way the rules are going.
So Laura, one place where this might bounce in for a dealer is if you're in a border city, and especially if you're not quite in a little bit more rural setting, if you're in a border city, your dealership may be in state A, but you've got technicians who live in 20, 30 miles into state B, and they do that 30-mile commute every day.
That's
You
a good
think I
point.
really don't need, I only need a sales tax permit where my store is. So I don't do service calls. I'm a car dealer. I don't do anything else. But that employee that you're holding withholding for in that other state where he lives, well, he's created Nexus for you. So any parts that you happen to be shipping across the river or the state line, you probably should have collected tax on. So that employee who drives in 30 miles from the other state, he's kind of created Nexus for you.
Yeah, no, I think that's a really good point, because a lot of times, at least in Arizona, we had a couple years ago, creative ways of going around taxes. Montana LLCs, that was kind of a fad for a while, but the states have over the time been extremely more creative in like how they can ensure compliance. So as someone who has come from that side of the tracks, I guess you could say, I can't stress enough how more of an issue this is going to become over the next couple of years. Income taxes. So one of the things I wanted to talk about this for income taxes is, let's use my friend California as an example. If you have pierced the threshold for sales tax in California, California will guarantee that we are going to have to file corporate taxes in California. Now, a lot of owners don't want to hear that, because if you have ever heard anything about California, you're going to know that California requires, if it's depending on the entity structure, the personal owners, if it's an S corp, to file personal non-resident returns in that state, and you would probably owe if there wasn't any withholding during that time. So what we're finding is that if you triggered it on one tax type, you're going to trigger it on the other tax type. So there is some, room or methodology. I don't want to say creative accounting, but there is something that, we could look at from a practical standpoint. But it is very important that you realize, if you're talking about, okay, we're going to start expanding our footprint in the dealership world into these 3 additional states, then I would really suggest you reach out to your tax professional and do some modeling to see how is this going to impact the owners, because it will definitely impact the owners. There's no doubt about it. And that tends to be where David and I see a lot of questions come up, is like, oh my gosh, now how am I going to explain to the owners that now they owe, California, tax, and they have to do withholding from this point forward. So the best way I always like to explain it is, it's not, think of it like sales taxes as a pie. You're just changing how many states get which piece of the pie. So think about it from that perspective. Also, what we've come across recently with all these issues, especially if you're a dealership in Washington, or maybe you have a location in Canada, or you're any, sister company. That's the other thing, is that affiliate entities, a lot of dealerships structures maybe they have one type of dealership here, but they have, a wholly owned or majority owned other dealership in a different entity. Those all still apply to the same rules. It's all in the same bucket. So in Washington, one of the things I wanted to talk about and bring up is they have a B&O tax. which I always feels like it's just something, weird, B&O. So like business and occupation tax. Um, and this is a tax that Washington put into place quite a few years ago. And this is what we call in our sales tax world a gross receipts tax. So if you are a dealership and you have Nexus in Washington, you're going to have sales tax, and then you also are going to have B&O tax. Now here's the big thing. And most of the time you can pass that sales tax on to your client. You can't pass B&O tax down. You can't put like a B&O tax line on your invoice. That's just asking for some trouble. So a lot of companies, if you're thinking about expanding into Washington, or maybe you realize you have Nexus, is that you kind of have to build in the B&O tax into your bottom line, because it is going to cut into it's going to cut into your profit margin for sure. So a couple months ago, Washington passed a new bill, and this bill says that based off your Nexus code, which is, your industry code, your B&O tax rate is going to vary. So it's usually pretty low, like usually less than 1%, but over the next year, it's going to change. So B&O tax they have their own Nexus rule, and that's kind of what this slide is talking about. So if you did over 885K in 2018 in Washington for sales of ship to and sales into Washington, then you have 285,000 into Washington, then you have triggered Nexus. I would also say that if you're getting close to 285K, you might need to make some sort of internal business decision that either you're going to just pull the trigger and say, okay, we have Nexus, we're going to start collecting and filing, or we're going to wait till we hit it and then on a go forward basis start collecting.
Especially now, this could be also important for heavy equipment dealers, not so much the auto dealers, but the industrial machinery dealers. A used crushing spread can be $500,000 and be sold and trucked direct into Washington.
Right.
And there we go. We're over the line. We're sales tax, Nexus, B&O, all kinds of things.
Right. So if you sold a bunch of inventory that maybe you wanted to get rid of, potentially, and that customer that's buying your inventory you want to get rid of is located in Washington,
and you don't have any Washington connection yet.
Yeah, you don't have a Washington connection. If you pierce that threshold, you have Nexus.
Yes. So you may want to just watch those when sales folks are making those remote sales that are getting trucked everywhere. Just kind of keep an eyeball on them.
Yeah, that's a very good point. Okay, so we're going to do our second polling question.
I've never left my dealership in Ede, South Dakota. The dealer calls me from Washington, and we trade a used combine. I send him a combine. He sends me a baler and some cash. I had some third party do the trucking both ways. Is it possible, even though I never left Ede, South Dakota, that I could be subject to the business and occupation tax in Washington?
Wow. Okay, fabulous.
Yep.
Yes, it is possible that you could definitely be subject to Washington B&O tax. So I guess maybe, that seems like a very simple question, but if you don't really operate in Washington and maybe you did one transaction, you kind of have to ask yourself, well, it was one deal. Do I really need to file? Do I really have Nexus? So the textbook answer is, yeah, you do. But then from a practical standpoint, you kind of need to think, how is this going to impact my business? Because once you start registering, like let's say you registered in Washington, that means Washington's going to want their sales tax report every couple of months if you're quarterly, or every month if you're monthly.
Death do you part.
Until death do you part. It's a relationship. Yeah. So on our website, if you were to go to eidebailey.com and click the little magnifying button on the right side and type in Wayfair, this is what you should see when it pops up. We have a warning sign that says, whoa, change is ahead. So the article, I guess it's more like a reference chart is what we should rename it to. We talk about how each state has chosen to pursue the Wayfair decision. Now, SCOTUS is the Supreme Court ruling, so that's just an acronym for that. But so if you were to click into that Wayfair chart or article, you'll see a reference matrix that looks like this. And what we've done is, well, this is an old screenshot because we should update this. We have an old screenshot, but Arizona has issued Wayfair guidance.
Yes.
California has issued Wayfair guidance. So if you were to click on it right now in real time, if you could find it, you're going to see that all the different states and all the different thresholds that they have. So what we've decided to do is put this out there for our clients or anyone else that wants to look at it and go, oh, okay, if you're a CFO, hey, I'm getting close in California, what are their rules? The same thing for Arizona. It's not shown on here, but if you were to click on it real time, you would see that they have a tiered threshold over the next 3 years. Connecticut, they've got this weird, both thresholds must be met. So that kind of speaks to what David mentioned earlier about the different types of economic nexus. Connecticut is one of two, I think, that they have both thresholds that have to be met, where that just means effective 12/1/18, you have to have 250K and gross receipts and 200 transactions. So if you just did one deal for 250,000 and you had one transaction, then you don't have Nexus. So we've kind of bifurcated and put different notes in here on the side for you to review if you wanted to check it out to see where else you might have Nexus.
And we update that not every day.
No, not daily.
Review it periodically, and if
we do
see changes, it gets updated fairly quickly. So it's not up to the minute accurate, but it's very good.
Well, I think it's pretty good compared to some of the other ones I've seen out there, but it's hard. I mean, there's 45 states and they all have these crazy different rules. If we try to keep as best track of the changes as we can. So we're going to hit our third polling question, which is a true or false. And is there an updated and important information about states' responses to Wayfair on eidbailey.com?
All right, we're going to go ahead and close this poll here. And here are the results.
Okay, yay. Not everybody's checking and responding to their emails. That's good. Okay, so let's keep trucking along here. I know that we're running close on time. So this is our big disclaimer at Eide Bailey, is that this is what it is today. It could change. We've already seen some of the states change their economic nexus. I'll give you an example. One of the states, I'll just pick on Connecticut, or not Connecticut. I don't know. Let's pick.
North Dakota's changed theirs.
North Dakota's changed theirs,
They
yes.
removed the 200 requirement.
Right. So North Dakota said, we don't care about the number of transactions. We're just going to go with the 100,000 in revenue. Here's another question I get a lot. Maybe you sell your vehicles to the government or to the city or local municipality. Just because it's government doesn't mean that it's exempt, and not unless it's the feds, which even then I would still want to question and look at that. But it's gross receipts. So even if you did 100%
Car sale.
car sale for resale, whatever, that number still counts towards your gross revenue threshold. So this is our disclaimer that this is what it is now. Could change tomorrow. We try to keep really good track of everything that's going on in terms of what the states are doing. We have already passed, most of the states have already sunsetted and legislation's not meeting anymore, but that's going to kick back up in January. So that's like Christmas for me. It's my favorite time of year when all the bills come out on how they want to change taxability by industry. We try to keep really good track of that. So another disclaimer is I always think about it as taking everything step by step, because this is like a whole new world for sales tax. So before you register in another state, we always kind of want to just, before you pull the trigger, make sure that you have a really good overall understanding of, okay, we're going to enter into, let's just pick on Arizona. I'm a Colorado company. I'm going to start selling stuff in Arizona. What do I need to do? What am I selling there? What have we done historically? Because you could find out, oh crap, we may have had Nexus there for a while because we had a sales guy there for 3 years. What do we do now? We always hesitate of like, well, you don't want to immediately start filing because you might open yourself up to prior look back periods for exposure. But one thing that we do offer, and this is something that if you do find out is an issue, you can do what we call VDA, which is a voluntary disclosure agreement. That process can be done for corporate tax, franchise tax, sales tax. Unfortunately, there's not many VDAs for like business personal property, but for the main tax types, if you find out, oh crap, we should have been filing in Arizona, you can apply to be part of a VDA. Now, VDAs are great if you can get accepted into the program, because some of the pros is that you are protected from those years being audited because you entered into a voluntary disclosure. And as long as you pay timely, they will remove any penalties that should have been accrued. So there's a lot of benefits to voluntary disclosure. And if you are an S Corp or flow through, and the owners might have some potential exposure as well as an individual level, they can often be included in the VDAs. So it helps protection at multiple levels.
If I were in a lot of states, if I haven't done anything and the auditor shows up, they may go back 6 or 8 years if you have never filed and they figure out you should have been. And most of these voluntary disclosure agreements, if you get into that program, part of the deal is they will only look back 3, maybe 4 years, and
Right.
they're forgiving all the old news.
Right, that's true. That's a very good
And
point.
you get to do this on your time schedule
Yes.
versus having the auditor sitting in your office, knocking on the door, wanting all the paperwork today.
Right. Yeah, exactly. And then here's another good thing is that if you're thinking about selling off a portion of your business, or maybe you want to get out of the business, or you're the seller or the buyer, if you're the buyer, you want to really make sure that the company you're purchasing doesn't have any potential tax liabilities for corporate or sales tax. And then if you're the seller, you want to make sure that you don't have any issues, because that's definitely going to affect your sale price. And I mean, the past couple of years have been really good in terms of the economy. And so we see this all the time, but I can't tell you how much of a big deal that VDA is. It just may not happen right away. So if you have any questions about that, you can always feel free to reach out to us too. And I would always suggest that this is down here. The state sends you an activity questionnaire. It looks like a very innocent survey.
But it's not.
They're extremely dangerous because usually when it's sent in, it has to be signed by someone, and that's pretty much like you're signing under penalty of perjury that all the information is true and correct. And what we find is a lot of times, it comes in through the mail. It might go to someone at probably a lower level in accounts payable or accounts receivable. They innocently fill it out and send it in. Now there's an issue. So if you ever see anything come from the state that looks like an innocent questionnaire or some sort of survey thing, I do not send it in without talking to your tax provider, just because that's how a lot of companies get hooked in. Texas is known for that. Just be careful. And so a couple of things. Here's how we've been able to help our clients. So for dealerships, we go in and we look at sales by state. We look at all the invoices, the folios, any type of sales activity, and then filing activities. What we do is when we kind of go in and do that like litmus test, we create an analysis or a diagnostic, and it's pretty much like a quickie snapshot of time of where the company is at, right? Where's your dealership right now in terms of sales tax compliance health, and then corporate tax compliance health. So it's like you go to the doctor, they do all this blood test, they give you all your test results, tell you, you need to lower your blood pressure, blah, blah, blah. We do that, but on the tax side for sales and corporate. Once we have the diagnostic analysis, we go through and give you all the information of here's what we saw, here's what we recommend, and we do that during our hour or half an hour review call. It's been really beneficial for some of our clients. This is kind of an example of what it looks like. It's been really beneficial because when it comes to tax time, what your company looked like from a corporate standpoint 2 years ago probably has completely changed since that time. So this is just the top portion of it. But if you can picture, it's all on one page, and we have all the states listed. We have all the thresholds. We've got all the gross sales by state, and we go through and explain, this is where you have issues. This is where you do not have issues. And the CFOs tend to really like it because it provides a top-down, simple one-page view of this is what we see, and here's how we can fix it to mitigate risk. So with that said, we're going to hit our last polling question, I believe, or close to last polling question. So this is a true or false question. If you think you may have Nexus in another state, you should immediately register for sales tax and not talk to a tax advisor.
True or false?
Sorry to say, it's not 100%.
Well,
So
there's
close, though.
yeah,
So
so
close.
close. That's okay. Yes,
We'll take it.
anytime before you shoot from the hip, you got to talk to your tax advisor, because there could be some weird change that nobody knows about come through. Like, for example, Oregon, just throw this out there if anybody's listening. Oregon last couple months ago passed a new gross receipts tax. So not only do they have the regular corporate tax, they now have a new tax on top of it. It's a new tax. So that's something to be aware of. We've got additional business trends that we call it's our trend series. We've been doing this for years at Eide Bailey. We've got a couple ones coming up that I would really encourage each of you to attend. IRS, everybody hates the IRS, and they're not fun to hear from it. So if you have any IRS problems, or maybe you're concerned, I would suggest that. Transfer pricing, as more of our companies, probably dealerships, you've got transfer pricing issues, especially if you're doing stuff between Canada and Mexico. We've got that huge problem,
Multi-store dealers.
Yeah, multi-store dealers, exactly. IC discs, and then we also talk about penalty abatement too. So these are some pretty good ones if you want to hop on the August business trends. I think everything's about Arizona. These are some good ones if you can make it. So with that, and I know we probably have 7 minutes left, I'll be more than happy to answer any questions that may have come through.
Sure thing. So the one that did come through is pretty long. So on
Okay.
your menu bar, do you see the Q&A box?
Yep. Okay. Got it. I got it open.
Okay.
Okay. So we are a dealership in Idaho and do business in Washington. That's very common. We look at the state and local we look up the state and local taxes and collect and submit these taxes to the state when they register their vehicle. Do these laws affect us when the individual comes in physically to sign the paperwork and drive the car away? That's a great question.
So we're looking for...
And what if they come in and sign the paperwork, but then the vehicle is delivered to them? That is a great question, because I'm sure this probably comes up a lot, especially if you're close to the border, right? David, do you want to respond to this one? And then I'll add anything extra. Okay, so I'll this is just my off the cuff answer. So if you're in Idaho and a Washington person comes into your dealership and purchases their vehicle, I bought my car in Idaho. But I live in Spokane and I'm driving across the border, right? That would be sourced as an Idaho sale. And here's why. It's because they're physically in Idaho taking possession of that property. And then once they drive off the lot, right, that's theirs. Once all that paperwork signed, that's theirs. So I would say that is a Idaho sale. So it would not necessarily affect the Nexus rules, because you're in Idaho, you already have Nexus in Idaho. So the second scenario is they come in, I'm a Washington resident, Laura Robichaud, Washington resident, coming over to Idaho, not an Idaho resident. I sign all the paperwork, but then my vehicle is delivered to me in Washington, right? I do not take possession of it. However, I physically came in and signed that paperwork. So I would say I would assume that someone, either the dealership or some sort of third-party dealer carrier, is going to transport that vehicle over into Washington. So that would be, well, that's actually an interesting point of view, because I could see it going two ways. My gut reaction is that's got to be Washington would have a very strong case to say that's a Washington sale.
And the good news for this is, as I recall, both Washington and Idaho have some fairly decent car dealer guides with examples of this in them.
Yes.
That is where
I can't remember the name of the publication, but if you want to email me or David directly, I'll be more than happy to send you that publication that gives the different examples. But it has to do with when the transfer of the possession of property occurs, right? So for that, I would say Idaho, they would try to, if you were under an audit, Idaho would say, well, they came in the state and signed it, yeah, but they didn't take possession of it. So that car from me, Laura, the Washington resident, that would be sourced as a Washington sale. So I hope that makes sense. But if you email me, we'll be more than happy to send you the publication. So the follow-up is, since it is 2019, can our out-of-state sales self-identify as in-state sales? I'm not sure what you mean by that.
I think that send me an email on that one.
Yeah,
And we'll chat
can
and
our
get the rest of
out-of-state
the
sales
story.
self-identify as in-state sales? I'm not I'm guessing you might mean that can you just say that anything that's out of state, you just source it to in-state and charge Idaho tax and then be done with it? I'm assuming that's what that means, but I could be wrong.
Idaho would love you, but the other states
Idaho
not
would
so
love
much.
you, but Washington would be really meany about it. So if I'm interpreting your question correctly, that's kind of how I think how you should handle it is, you can't really self-identify as in-state sales because you're going to have to look at each state's rules. Yeah, sorry. I hope I answered your question, but if I didn't, you can totally email me or call me and we can talk through it. If I didn't answer that properly. Yeah. Were there any other questions? Oh, you're welcome. Were there any other questions that came up, Amy?
Nope, that was it. So thank you,
Okay,
everyone.
cool. Yeah, thanks. So there's our contact information. And then, Amy, did you want to go through the CPE thing really fast?
Sure. So this webinar was recorded. We will get it edited and fixed and ready to send out to everyone. Give us a couple weeks to do that. Also give us about 10 to 14 days to get all the CPE compliance in, and then we will issue certificates. And if you do have any questions, please don't hesitate to reach out to David or Laura, and we'll get you get your questions answered. So thank you everyone for attending, and I hope you have a great day. Thanks, Laura. Thanks, David.
Thanks.